All right, and we're live. Welcome to Tuesdays at TNT. We usually hang out on Thursdays, but we're trying out a new thing here called the Investment Prep Video Series. I got my very good friend Tim Lin here to hang out with us, and we're going to talk a little bit about, you know, unpacking the due diligence process, raising money for an angel round, and what it's all about. I'm really excited that the Spring Investment Summit is coming up. Applications are live. The big event will be happening June 17th, but applications are live right now on our website. It's about an 8-week due diligence process that's going to start at the end of the month. So you got a couple of weeks here to get your applications in. Simple application on our website. Encourage everyone to go there, startuptnt.com/investment summit. Sort of the motivation behind what we're doing right now is that when we talk to a lot of the companies that come through the process, we know that out of 80 or so companies that might apply, only a small percentage of them are actually going to raise money from the investors. But we're here to try and raise the game for all of us in the community, both the investors and the entrepreneurs working together, figuring out, fundraising best practices, what it takes to build a great company, how to structure the deal, how to build those relationships, how to gain trust, how to go through due diligence and make great things happen. So one of the key learnings we've heard is that people would love to understand a little more detail around what's really going to happen when you're going through due diligence. So I've got one of Startup TNT's foremost experts on this topic, Mr. Tim Lin. Tim, say hello.
Zack Storms, how's it going, man?
Tim, thanks for coming on the show today. Tell us a little bit about your background before we jump into this. You help us out at Startup TNT. I think a lot of people see you co-hosting pitch nights with us, running the summits. But what does Tim do outside of Startup TNT?
Well, I'm here with, I guess, both my co-founders right now. I've got Zack on the TNT side of my life, and then Brendan is also here to be able to chime in on the financial advisory side of life. So the other half of what I do is it's part private equity and trying to find a company or two to buy, and part, call it contract CFO, financial advisory, getting ready to raise money, helping the deal close, helping affect a transaction, helping with growth and strategy. Really, the way that I like to describe that what we do is sort of a right-hand financial brain to the C-suite or management of a company, whether that's a startup or a traditional business or whatever needs to happen.
I know that you've experienced M&A activity from a few different perspectives. You were part of Sensasure, a great startup company from Edmonton that was acquired, and you've worked at Deloitte in their M&A practice. You want to tell us any more about those experiences?
Yeah, I mean, there's not that much more to say beyond those things. So Sensasure we were building a sensor that goes on the outside of a diaper, and it measures the level of wetness on the inside from the outside, and then it relays that information to nursing home caregivers so they don't want to change the residence. Lived in nursing homes in Maryland and then Toronto and then San Francisco, and then ultimately sold the thing off to a Swedish multinational called SCA, now called Essity. Moved back home to Edmonton, want to be home with friends and family, which is why I'm here, and started working at Deloitte, helping other people sell their businesses and do other sorts of transactions. So worked on sell side as small as we'll call it a small chemicals management buyout, to a large $250 million sale of a company to a public company called Thermon. And then also helped with some advisory work, like helped the city do some stuff with Northlands and figuring that side of things out, helped on a buy side of ironically enough, a nursing home, helped raise some money for a consumer brand company here in Edmonton. And then, got enough of my fill there and wanted to go and do my own entrepreneurial thing. So have been spooling up TNT along with you, of course, Zack, and then trying to find, like I said, some companies to buy and some companies to advise with Brendan. It's been a bunch of fun.
Well, awesome. I think that's a good segue. Let's introduce Brendan Hance, one of the first investors I ever recruited to join us at the Investment Summit. I met this guy at Edmonton's go-to meetup spot for anybody who wants to do something in the startup space, DOSC. And he showed up wearing a hat like me, and I was like, I think we're going to be friends, Brendan. Brendan, say hello. What's going on?
Hey, everyone. So as Tim mentioned, Tim and I work together in a consulting practice called 4th Street Consulting, where we spend a bunch of time helping largely small to medium-sized enterprises with their financial affairs. And part and parcel to that, Tim and I have had a lot of opportunities to work with startups hone their pitch and their due diligence rooms, which is part of what we're here to talk about today.
Yeah, I know that sometimes you get pretty hands-on with some of the companies. Can you share with us any like maybe ag tech companies we might have heard of that you get involved with that we should know about?
Yeah, part-time CFO for G2V Optics. Gone through, I don't know, a couple capital raises now, and been fortunate enough to get a number of grants to help us continue on our growth path. And with that, we've had a lot of experience having to build out due diligence rooms and do some financial modeling and help on the strategic planning side. And so that's one of the companies that I've worked with Zack. And then in my past life, I was, I guess you could call the CFO of my family's business, and spent 4 or 5 years there, getting it prepped for sale. And in 2017, we were fortunate enough to be able to sell it. So I've been through a couple sell side transactions now, with on the personal side, on my family side, and then actually Tim and I have another sell side engagement that we're helping a guy with right now. He's selling off half his business. So we have some experience on the financial side, dealing with transactions and what that entails.
Yeah. So involved in different types of financial transactions, different types of companies, traditional retail, fast growth, scale up companies. So let's get into it, guys. Let's talk about raising an angel round. Who are we talking about? What types of companies raise an angel round in general? Join us at the Startup TNT investment summits. What's the typical profile?
I mean, I'd say it's probably a pretty wide range. I'd say probably the more relevant question is who's successful at the end of it. And the folks that are successful at the end of it tend to be folks that are raising, somewhere in the realm of like 300, 500K on the bottom end, to somewhere in the realm of 1.5, 2 million on the top end. Typically it's folks that have already raised money from friends and family, folks that have built their product and are going to market. Depends on the type of industry. Like, there's obviously biotech, you can't really be in market already. Like, if it's like a deep science project, you can't really be in market already. But for the consumer or B2B SaaS or stuff like that, it's already in market, already have early semblance of sales, and a really exciting path to growth, and a really exciting path forward that really gets the investors going, and de-risk a whole bunch of the idea stage stuff by having it already done, but have a whole lot of the growth and exciting part ahead. And those are really the ones that get the investors going.
Yeah. Okay. Good comments. We've been looking at some of our companies. I think we've had now 173 companies apply, guys. 114 investors participate. And yeah, we're seeing companies raising between, I'd say on the low end, 250K to 2 million. But I do agree with Tim. Usually when the company's raising at least 500K, it makes for a better story for the investors. It sounds like it's a sizable amount of money that could have an impact. Valuations we're seeing are often between $2 and $8 million. And generally the revenues are still quite low, somewhere between $0 and $1 million a year. So, and also I just want to talk for a moment about the different types of companies that are raising money from angel investors, because we've seen a lot at Startup TNT Investment Summit. There's lots of different companies out there. People often talk about the tech entrepreneur, but really what types of companies are we talking about, do you guys think, that need angel money or a good fit for raising angel money?
I don't think you have to put a label on it. And this is just my opinion. I don't think you need to be a tech company to necessarily raise angel funds. Personally, my family's invested in a couple things that wouldn't be classified as technology, but would be probably classified as an angel investment. Capital is required to grow your business, and whether you're a traditional food manufacturer or a retail business, still requires money to get it going. Or subsequently, if you're a technology startup, you also need the capital to prove your tech and grow your revenue stream. So I don't think you necessarily need to be a technology play to raise angel investment.
Yeah, awesome point, Brendan. I agree with you 100%. People are raising money to scale their company. Could be a tech-based company, could be something else. And at the Startup TNT Investment Summit, we have seen, companies ranging from, food companies to B2B SaaS companies to B2C software products, to, hardware companies in the industrial space, medical device companies, all types of companies raising money. It's definitely hard to put them into a box. And that's why we like to welcome everybody. Nobody wants to miss out on a great local company. So why label them? Excellent point, Brendan.
Yeah,
okay, guys.
I think
Yeah, go
the
ahead.
common theme though is is that they're all looking to become, you know, very large companies. This isn't like a single store retail play or something like that. I think that what angel investors like to invest in is something that has a strong potential for growth, and not just you know, going to invest at a $1 million valuation and get, you know, $100,000 a year dividends for the foreseeable future. That's kind of not the. I think that's what it's not.
Right. I think that's an excellent point. Looking for companies that are going to scale, have likely a global or at least a national customer base, and looking to be something much bigger than just an Edmonton company. Absolutely. I think that's great. Great point. Okay, I do want to remind people that are on the chat or on the live stream, you can post questions or comments if you want to, and we'll try and field them. Otherwise, we're going to keep chugging along because really what we want to do is unpack the due diligence process for people that are participating. So let's start with, what is due diligence and why do people do it? What are we referring to when we talk about due diligence?
Hey, Tim, I think your analogy that we used a couple of weeks ago was interesting. The one about like opening the door and looking behind the scenes. A useful one in this context.
I share this with the investors. There's the exciting part, which is when you hear the pitch and everything's like bright and shiny, and there's this nice coat of veneer that's sitting on top of the startup. And then the due diligence part is, okay, well, I've heard the pitch. Now I'm really excited about this thing. You've told me that this is going to go to the moon. We're going to be worth $1 billion. We're going to be the next Facebook. This is, you know, we're going to smash this thing out of the park. And then realistically, what happens is what you want to do as an investor is actually like, you know, ask a few questions, dig in a little bit behind the assumptions, understand what's going on and what's happened to date and what the actual tangible plans are for growth, and ask a little bit more of the hard-hitting questions to figure out, you know, how likely is it this is actually going to happen. And to Brendan's point, the analogy that I use is it's sort of like the Wizard of Oz. You know, you hear the magical voice and it's everybody's kind of, you know, checking out, running towards the you know, on the yellow brick road, and everybody's all gung-ho and happy and trying to get there. And then you get there and you take a peek behind the curtain, you're like, oh shit, this is actually just some dude. This isn't like some magical thing. We're going to turn it into this magical thing. And that's the difference between the Wizard of Oz, but definitely not there yet. And the purpose of due diligence is to figure out what that plan is to be able to get there, and notice that there's a whole pile of skeletons in the closet, and then like close it up and either make the bet as to whether or not this is going to happen, and make the bet or not.
Well, someone brings up a point here on this topic that says there can sometimes be a disconnect between what an entrepreneur thinks they need to launch or will launch into something successful and what will actually attract an angel investor. You guys, any comments on that in terms of like what the expectations are for success between the investor and the entrepreneur?
I think this is an interesting point that Mark brings up, because I've seen it on a few occasions. As an investor, you have a lot of opportunities to place capital in various things, you know, from GICs that are relatively risk-free at like, you know, earning 1 or 2% to public markets portfolios that might chug out 5%, debt that might kick out 10%. And then, you know, then you have this like black box of angel investing that, you know, your goal, I think, in your portfolio of angel investments is to clip out that 30 to 40% return in the portfolio that you're building. And so I think there's often a disconnect between valuation, sometimes in what an entrepreneur expects versus what an investor expects, as well as just the understanding that like investors have a lot of opportunities and you know, see lots of deals throughout the year, and if you're not organized and if you're not presenting your story in a credible and like compelling way that's succinct and easy to understand, you know, your time as an investor is precious, and for me to like wade through hours and hours of due diligence and try to figure out what exactly the business is, you know, likely you're just going to get a no right off the bat, or it's much easier path to saying no. So I think those few things I think are super important when you're talking to investors.
Those are really good points, Brendan. You know, it reminds me of like investors are often an angel investor in particular is doing this on the side. And so anytime he hits a barrier or she hits a barrier, anything that comes up that's like some sort of signal that like maybe this isn't as great as I thought it was, they'll just like immediately stop the process. And so for you as the entrepreneur to make it as easy as possible for them to go through and understand that this is a credible idea, there's something real here. We can really we got the people in place and the plan in place to make this happen. 100% agree with that.
Yeah.
I do want to bring up one point though, just to remind people. We have seen companies that are pre-revenue, quite a few pre-revenue companies raising money in Startup TNT. So I do think that, if you're still an early stage angel entrepreneur, you can raise money before you get revenue. But I think like Brendan says, you have to have the credible plan in place. You still need to do all your homework and treat it like a very, very serious transaction.
Yeah. I mean, demonstrating traction, I think, is the most important thing that an entrepreneur can do. Whether usually revenue is the easiest way to demonstrate traction because there's dollars and cents behind it, and that forms a business. But could be LOIs, could be if you're building a product, TRL stages as you're going through it. If it's like a science project type thing, all the sorts of whatever the form of traction is for the business, I think is probably one of the more important ways of going about it. And then of course, to what you just said, Zach, like not disturbing momentum. Like if you overstate it in the pitch and then you go in and then you look, it's like, oh, you're actually not even close to there. It's kind of game over. If there's one thing that I've learned about deals, it's that the most important thing that you can have is momentum. And there's nothing that kills a deal faster than losing momentum. And whether that's, to that same point, falling back on the traction or the development path, whether that's not having any sort of sense of urgency on the transaction to be able to drive it to close, whether it's, not having any of the documents in order, which is most of what the rest of this conversation, I assume, is going to be about. Whether it's, any sort of thing that can prove to be a stumbling block. There's a whole pile of like helpful to have a whole bunch of prep ahead of time done so that the momentum can be carried through.
Yeah, excellent point. So actually, let's go from there into a little bit more detail about the process and preparing those documents, because I think that is really the opportunity for entrepreneurs to understand it. And really, my personal philosophy and our joint philosophy as an organization is that, come join us at Startup TNT, learn about the process before you're actually ready to invest, take away the key messages, and then come back when you are ready. It's going to be that much easier. It is a long-term relationship building process as well between the entrepreneur and the investor. So guys, like you guys have kind of touched on, I'll summarize them as like three components of due diligence very broadly. One is that sort of initial pitch to get the person hooked, and we incorporate a pitch night at Startup TNT for sure. Another one is that initial follow-up meeting. You're excited, you want to go talk to the entrepreneur now, the company, learn about it. And then the one that I think is often a black box for a lot of entrepreneurs is opening up the door and like, what does that process look like? So I'd like to kick things off with that initial coffee meeting. Tell us a little bit about, like, you hear the pitch, whether it's a 1-minute pitch or just a referral, you want to have the initial meeting with the entrepreneur for 30 minutes or an hour. Like, what is that conversation going to look like that says to you, I want to fully open this door and really see what's under the hood?
Yeah, I mean, I think everybody takes it a little bit differently. Brendan could probably share his what he's looking for in that meeting. What I typically look at is, you hear the pitch, it's pretty good. It's, a 3 to 5 minute pitch because at TNT, it's Zack and I both get distracted with pitches that are longer than that. And so that's about the length of pitch. And so it's more of just like a glimmer of what the company kind of is. The meeting is mostly to get a sense of what's driving the entrepreneur, where this idea come from and why are they passionate about it, I think is super important, because at this stage, it's a bet on the entrepreneur, and making sure that they're passionate about what they're up to means that they'll actually see it through to completion. So that's pretty important. What else is important is making sure that they actually understand what the business is. So something to the effect of, making sure that what they say aligns with the pitch deck, making sure that the story all checks out, making sure that they actually have an intentional plan to be able to develop this thing, and they've actually thought stuff through. That's most of the rest of the meeting from my perspective, is like essentially seeing how bright they are and how well they've actually thought this out, is most of what I'm trying to poke holes in. Because at the point that I'm taking the meeting, I'm interested in the industry, I'm interested in the business at a high level, and I'm now just trying to see, cool, where is this going to kind of go go awry, and can I trust them to make the hard decisions going forward?
Okay, guys, great comments, Tim. I actually want to tie this to a question that was just posed, which is, are 5-year financial projections not really required anymore? And I feel like you were kind of hitting on this, especially in these early days. Really, it's like the next 6 to 12 to 18 months at most that people care about. Like, where's that initial traction coming from? What's happening? What does the next time horizon look like that you can do? You were shaking your head at me. Was that a disagreement?
Yeah.
I don't think it's important for us to like understand to get like nitty gritty details on like your year 3 through 5, because it's largely this. I mean, the whole concept of building a model is like largely a guessing game. So you can make it look however you want. I think what it's important for is a couple things to get alignment around like where you're planning on going. If I see a financial model that says, oh, I'm raising money at a $5 million valuation and your 5th year of revenue is $2 million, there's a bit of a disconnect between like the valuation and what you're expecting to do with this business. So there's that. I also think that where the model is really important is to just understand how an entrepreneur or a business owner is thinking about the business. Have you thought about all of the critical components? If you're selling a hardware, that requires product support, but you don't have any product support people built out in your business plan. Have you thought about that? Like, do you understand like how to build a business or think through, what hires are going to be required and when? I think that's where the model is important. And I think from my perspective, working with a number of entrepreneurs, that it's a really important process to go through as an entrepreneur so that you can answer important questions that might come up. So it's really an exercise that's valuable for you to internalize, how this business is going to work, and then be able to communicate that in a confident manner. So I think those are a couple of things that I would articulate.
So to summarize for Mark here, the plan is important, but not super detailed for being long-term horizon.
Being detailed, like the whole, to my point of like figuring out the passion to make sure that they're actually going to be able to do it, and then like asking a whole bunch of probing questions to see if they actually get it. The model is that, but in numbers and like really tangible, and you really have to understand, like if you can see what's happening there and they can articulate what's going on in a model, it means that they genuinely understand what's going on.
Yeah. I'm smiling because you know that I'm not a detail-oriented person. So when people send me a 5-year detailed plan, I'm not going to look at it. Thanks, guys.
I also think it becomes much more important once you're hitting your stride on like revenue. So
yeah,
if you're a subscription-based service and now all of a sudden you're at $1 million in revenue, and we go through your model and you're like, oh, I'm going to get to $50 million and I just need $1 million to pump into marketing. I think it's very important to be able to like look at that, especially if you're going through due diligence with like any sort of sophisticated plan. I think like you need to have that in place to be able to confidently answer questions. So
yeah, I think so. There's some questions coming up around the specifics of what needs to be done in a financial model. I think the key thing needs to be that you articulate in numbers that your business is going to make sense going forward, and that the unit economics work, that you understand how many people are involved at a given level of scale, that you like understand the financial mechanics of how this thing is going to work going forward. It's not a projection of reality. It's a current understanding of what the business at various levels of scale will look like and kind of what it takes in order to get there. Nobody expects the future to actually look the way that it is on paper. It's more of just like if it was this big, it would kind of look like this, and therefore it's something that makes sense to invest in.
Yeah, and if I were to restate some of my earlier comments, I think that if you as an entrepreneur have done all the stuff that Tim's talking about, where like over the last 3 to 6 months or 12 months, whatever timeline it is, like you've actually figured out your customer acquisition costs, your various costs, all these different things, and then the financial projections come relatively simple. It's like, well, if I'm in one city, this is the number. If I'm in 25 cities, it's this number. So to me, those 5-year projections become less important.
And it costs this much in order to set up in a city, and we need this many people at the overhead level, or I don't know, it depends on what the business is, of course. But that's kind of the high level mechanics of what you'd be looking at as an investor.
I have a fun exercise for us though.
Someone asked whether a 3-year plan is sufficient or not. I think it is. I think again, it comes back to what would, as an entrepreneur, what would make you comfortable answering some of these questions? And if you put together a fairly detailed 3-year plan and that helps you articulate the business model, then great. I don't think you necessarily need to go out the full 5 years.
Yeah.
But if someone asks you, like, where's this business going? You're raising at a $5 million valuation, and where are you going to take it to? And your 3-year projection you haven't thought that far ahead. It might be worthwhile adding those extra couple of years. It's not that hard. You can just extrapolate it out. But
it's like an extra 5 or 10% of work to go from 3 to 5 years. So you've done like the bulk of the work already. Zach, what do we want to do?
Yeah, guys, we are supposed to stop this in 4 minutes. So let me show you a little exercise I did. As you guys know, and maybe other people listening don't know, I like to talk to myself. So this morning, I actually did a little due diligence on myself, wrote myself a little deal memo about me and Startup TNT. So this is what we use at Startup TNT to share information after that initial coffee meeting with people. So I thought I'd just share it with you guys, and you can see what it looks like. Give us some feedback. All right, are you checking it out here? Startup TNT. Yeah. We're not for profit. I have a little summary of the company up here. Motto is to have fun, make friends, build companies. Build an awesome startup community together. And one of the key things here that we need money for is we have a core belief that friends should buy friends beers on a regular basis. It's a small way to show leadership, so we always need people to contribute to our beer fund. So we're trying to raise consistent $30,000 for that beer fund. We've got a little investment opportunity summary. There is no valuation because it's not for profit. One important note about the investment instrument is that you will not get your money back because it's a donation. We have done this in the past. We've had some, pretty impressive people donate to us in the past, like John Pinsent, great local investor. We're open throughout 2021. It's an ongoing raise, and it's a really exciting opportunity. Now, going through this, we like to put red flags right at the top. So as I was going through this, I did put up the initial red flag, no investment return. What do you guys think? Is that an issue?
Yeah, it's probably an issue.
Any other red flags that come to mind, like basic ones? Another one that comes to my mind is when the company has not yet incorporated or doesn't have basic documents in place. That's like another one, like they're not actually ready to raise money yet.
Yeah, another red flag is when the founders have never put in money into the thing, or family or whatever. There's been no other investment, no background in it, no the red flags are pretty unique and obvious to an outside person. But Brendan?
Yeah, I think as an investor, you're often looking at the team as do you think this is the team that can take this idea across the finish line, or teams have the ability to pivot, and if this isn't the right idea, is this the team that can think through problems and solve problems as they go forward? Because entrepreneurship's not a straight line. Yeah. And so we spend a lot of time on the team. We especially specifically looking at red flags. We spend some time, or at least for me, I spend some time looking at like customer economics and how that works. To Tim's point, teams or entrepreneurs that don't have capital in the business, I always shy away from. But that's just me personally. And then I think each investor has a slightly different lens. They might have been burned on an investment before, and that throws up certain red flags that they've had in the past. So
yeah. Well, I will note, I did put on the team slide here to one of your comments, Zack has personally invested over $1,000 in the beer fund. So I'm in on this, guys. I'm committed.
Yeah. Hey, I say that, to the question, would you do this? Yeah, I said no, but the answer is obviously yes, because I've done it too.
I put a couple of comments in there on coachability. So you guys talk about team. We put this in our thing. Wait, let's deconstruct coachability just for a moment. Anything stick out to you that would be a red flag on the coachability side?
With you or
yeah. So
or in general?
Zack is a bit loud, but we think he can be coached. He's American, but seems integrated into Canadian society. He's open to delivering wine as well as beer. Are those good things or bad things?
I mean, those are good things. loud like a strong opinion loosely held, I think, is an important thing. Both of those things are, I think, important for an entrepreneur. Both the strong opinion, because without conviction, you're not going to be able to do anything, but then loosely held so you can change your mind when you get more information, I think is useful. And it's hard. It's a weird, but super important balance.
Okay, guys, I don't want to go through all of this in detail. I kind of just wanted to show this so people could see that, you know, this is sort of like a basic level of information sharing that we do as an angel group. Other angels do like this, either for themselves when they're taking notes. We kind of cover like all the kind of basic aspects of a business, like the big buckets: competition, market validation, what kind of traction do we have, you know, what kind of look, I didn't put notable people have donated to the beer fund. And then there's a little step here called next steps. So I think maybe I kind of wanted to bring it back to this to end it with, like, what are the next steps after this? This is like a basic deal memo. You know, if you read this deal memo and you're like, you're pretty excited about it, what's going to happen next? You know, now is when we actually have to go in detail and look at all those things and sort of fact check everything. So what does that look like?
I think this is like a very much like if you talked a little bit earlier about like an initial coffee meeting with an investor. These are some of the questions that you might get probed on if you're raising angel money at like a high level. And then after that, if someone is keenly interested in what you're up to, then typically you'd open up a diligence room for those folks to look through. And, you know, there's basically, you know, if I identify some red flags in a potential investment, then once the deal room opens, then those are when I go in and, you know, look for things to help alleviate my concerns. Or maybe, you know, certain investors might, you know, depending on the amount of money, they might put in certain restrictions on, like, you know, employee pay, but all that stuff would come out of more in-depth due diligence room that you would open up for an investor.
We're going to end this thing at right in a minute here or so, but let's just give a preview for what's coming next, because you mentioned the room, the data room. Tim mentioned at the beginning opening up the door. Sounds like we're going into a room. What is this room? What are we talking about, guys?
Well, I mean, it's essentially call it like a Google Drive or a Dropbox folder that houses a whole bunch of documents about the company, you know, including the pitch deck and model, the constating document, some of the backup around traction, some of the backup around, you know, just the things that are going on in the business, the contracts, some of the stuff that an investor would want to see to confirm, you know, for all an investor knows, you're just making a whole bunch of shit up and putting it on a pitch deck. And the whole point is to confirm that these things actually truly do exist, and the things that you're stating as true are actually true. So it's partially that, and then partially what they're doing is they're just seeing how organized and thoughtful you are, and it's a signaling exercise as well. So that's kind of the VDR in a nutshell.
Yeah. And then back to my earlier point, Zach, like, you know, if your data room is disorganized or documents are all over the place, like, that's a really strong signal to me that you haven't taken like the time or care enough about my time for me to even consider it. And so I think it's important to have a well-organized due diligence room with all of the documents, have proper summaries, and then be able to articulate and answer questions if they arise. But a lot of what Tim said earlier about, you know, it being a signaling exercise, I think it's a strong signal to the investment community if you have a really well organized data room that you've spent some time and effort into. If you have all of that together, then, you know, obviously I think it's easier to raise money. Doesn't guarantee it, but it makes it easier, I think.
And so we're going to end it here, because the next episode I'd like to do next week, I'd like to bring you guys back, and I'd like you to teach me how to organize our documents into a data room that makes sense to investors. Can you guys do that? You guys free next Tuesday, noon?
Okay. I just checked my calendar. Yeah, I'm good.
Did you just check your calendar? Okay, let's end it there. Next week, let's go into a deeper dive on what actually is in a data room, how to organize it, you know, and maybe point people towards resources that they can use to help them as they build it. How's that sound?
Perfect.
Let's do it.
Okay, thanks everybody for tuning in. We will make these available to everybody, and please join us at the next investment summit.
Thanks, Zack.
We're open. Thanks, guys. Thanks, Brendan. Thanks, Tim. Let's call it here.
Good, man.
See you, Zack.